Let's talk about pairs trading again. It is the main strategy used by Edward Thorp to make his 800 million fortune. Now, if you don't know who that is, he's the guy who invented card counting and proved that blackjack can be beaten mathematically. He also invented the first wearable computer, but not to see time or anything like that, but to beat the roulette game. He tried it secretly in Las Vegas using his physicist buddy Claude Shannon. Now, if you don't know who that is, he's the father of information theory, and together they literally hacked the roulette game. He also invented quantitative trading, with his most dominant strategy being pairs trading, or as he usually called it, statistical arbitrage, which is a market neutral strategy, meaning that you're gonna make money whether the price goes up, down, or whatever, because at each point we're gonna have one long and short position simultaneously, so the trend of the market is not what we are looking for. Now, if you want to know more about Edward Thorp himself, I suggest reading his book, A Man for All Markets. In this video, I will go through the basics of pairs trading very quickly. So if you haven't watched my previous video about this topic, don't worry about it. But if you have, don't skip this video, because in this one, I'm going to extend where I left the previous video and share with you the experience that I had running this strategy for a while. And before we continue, I gotta say I am not a financial advisor and this video is merely a tutorial. Alright, let's get to it. To show you the basics, I'm gonna use a Jupyter notebook, which if you wanna run it yourself, feel free to copy the code and run it inside a Jupyter notebook. But since we are using the Jessie framework in order to import the data and some other stuff, you need to ensure that this notebook is inside the root of your Jessie project. Now, if you're wondering what your project is in Jessie, well, it's the one that has the folders of strategies and storage. And here, as you can see, is my Jupyter notebook. Now, in it, I am simply importing the research module of Jessie and its utility functions, which are really helpful, and you're gonna see it in a second. And its helpers and the NumPy library, the datetime, and the matplotlib, so I can print out some beautiful charts for you guys. And you need to ensure to choose the correct Conda environment where Jessie itself is installed. And for me, this is the path to that one. So now I'm able to run this. Now, next, I'm going to choose the Binance Perpetual Futures as the exchange, because in order to go long and short simultaneously, you cannot do that on a spot market, right? So you need a perpetual futures market. As for the start date, I'm picking the first day of 2025, and the finish date is the first day of September. And then I'm using the research module's get candles function of Jessie to get the candles. Here's the exchange, the symbol, and the time frame. I'm using 15 minutes. This, by the way, could be anything, so you just need to play around with it and find the correct time frame for your strategy. Obviously, the lower the time frame, it's gonna take more trades, so you will be catching more opportunities, but as a result, you will be taking more trades and end up paying more trading fees. So that's the downside of choosing a lower time frame. By the way, the reason I'm using an underscore here is because I'm telling Python, hey, drop the first value that you're getting from this function here, and I'm only interested in the second one, because the first one is the warm-up candles, which we don't really need it in this Jupyter notebook, but if you are executing some actual backtest with it, you're gonna need it. But anyways, just forget about it and use it as this, because we're gonna run the actual backtest inside the Jessie framework itself, and we don't need to know about these stuff, and it will take care of them behind the scenes for us. All right, so let's run this, and as you can see, it's gonna take a while, and it's done. Next, I made an array of times in order to be able to show this on a chart. And then I'm using the utility function of Jessie called prices to returns to convert the prices into returns. And the reason I'm doing that is, you see, we're using Ethereum and Ethereum Classic for this example. And Ethereum itself has a price ranges of thousands of dollars, but Ethereum Classic has prices in hundreds of dollars. So in order to be able to do the calculation, we need them both to be inside the same range. And to do that, we're gonna convert the prices into returns. And next, I'm simply creating a chart using matplotlib library. So let's see how this looks like. All right, so you see they both begin from the same point, which makes sense. And at some point, Ethereum Classic, which is this red line here, by the way, you can see in here, is above the price of Ethereum itself, and sometimes it's below this one. So in simple words, what that means is that if I were to go long Ethereum Classic here and short Ethereum itself, and then at this point, if I were to close that position, I would have made money. And I could have done the opposite. So here I could have gone short on Ethereum Classic and long on Ethereum itself. And then at another point, such as here, I could have closed that position. And there's been so many other opportunities in here, right? So you see, that's what I meant when I said we don't really care about the trend. Like, it doesn't matter if where the actual price is going, because in reality, yes, both Ethereum and Ethereum Classic move together. They are correlated, right? So they either move up together or down together, but not exactly, right? So it's not right to the point. And those are the times that we want to use as our edge in order to make money. So the question is, how do we exactly measure this? So this difference that I'm seeing on the chart, and I explained it right now, how do we measure it with actual numbers so we can write the code to do it automatically for us? Now, to do that, we're going to need something called z-score. which is not really that complicated. So it basically needs how much further the price is moving away from the mean of itself. Now first we calculate the spread, which is the difference between the two price ranges. And then we calculate the z-score. And Jessie already gives us a utility function for that, but if you are interested about the formula of that, so here it is. So the price ranges minus the mean of that series divided by a standard deviation of the same series. So it's nothing fancy, but very useful. Then we get the mean using NumPy's mean function. And now if we plot it again, so you see the blue line here is the z-score, and this red and green lines are simply two thresholds that we are defining. So I have used the numbers 1.2, you could choose whatever you want. But the lower the threshold number, the more trades you're gonna take. All right, so this is very simple. Basically, we wanna say that whenever the z-score goes above this red threshold, we wanna go short the first asset and long the other one. And then we close it whenever it reaches the mean, which is this black line here. And whenever it goes below the minus 1.2 threshold line, we wanna go long the first asset and short the other one. Now we can also check statistically to ensure the two assets are in fact conjugated, because we don't just want them to be correlated, which is they are moving together. We also want to make sure they are conjugated. Now I'm super simplifying these terms, so if you want to know about them, make sure to look them up. But since Jessie is providing these functions for us, it's not going to be that hard to calculate it. And if I run this, you can see the result, which is it's saying yes, it is conjugated. So these two assets are fine to trade. But maybe the assets that you want to trade are not so obvious, like Ethereum and Ethereum Classic. Maybe you want to run it on two assets, such as the token of two different exchanges, such as DYDX and let's say the Hype token. Before running it, you want to ensure they are indeed conjugated. So for that, you can use this utility function. Alright, so there's one issue. If I were to write the strategy and run it with these exact numbers, I would have fall into the look ahead bias. What that means is that because we already have all the data and we are calculating the mean for the entire data, and then we are choosing these threshold lines such as 1.2, we are using data from the future. So if you execute the strategy with this, we're going to see good numbers, but when you actually run the same strategy, it is not going to perform as well. So to fix that, we need to ensure that we only use the data that we already have. But one of the good things about Jessie Framework is that when you use the data inside the strategy, you will only have access to the data so far. That means you will never have access to the future data. So you don't really need to worry about this, but I just needed to mention this because I know some of you who know the math better than me are now thinking, oh, what this guy just did is the look-ahead bias. Now here's a previous video that I made about this topic, and in the description section of the video I was linking to this GitHub repository. Now in it we simply have two strategies, pair trading and pair trading 2. So pair trading 2 is actually simpler, so let me show you that first. Alright, so you see this strategy is simply following whatever logic the first strategy is giving. So it's reading the values that have been set by the first strategies using the self.shared vars dictionary of Jessie to know whichever position should go long or short, or whether or not it is time for it to close or liquidate the current position. So it's pretty simple, and in fact we don't need to change this code like at all. So instead let's go to the first strategy and check out the source code. So let's make this a little bigger. Alright, so first we have the typical imports of a Jessie strategy. So we're importing the main strategy class, the indicators package, and the utility functions. And we simply define the pair trading class, and it is inheriting from the main strategy class. So this is 101 strategy in Jessie, and in fact when you generate a strategy using the dashboard, it will generate these things for you. Now since we were doing our calculations using the price returns and not even price data, let alone to something like candlesticks, that is why in here we also need to convert the candle data into price returns. So we're using the utility function of Jessie called prices returns, and in it we're using the getCandles function of Jessie to fetch the current data for our trading time frame, symbol, and exchange, and we're selecting only the closing data. And then we're picking the last 200 candles. And this is expected, right? Because if we want to do some calculation based on the past existing data, we need some kind of look back period, right? And in this strategy, I chose the number 200. You can test your own number to see whichever works best for you. And next we did the same thing, except using the other symbol. So by the way, I could have hard coded this. So for example, this could have been ETH and this one could have been ETC, but I use the self.route array of Jessie, which will give me basically a list of the routes that I'm trading. And because in this case, I'm supposedly trading two symbols, so let's say ETH and ETC, then I know that the first one is going to be ETH and the second is going to be ETC. Next, we calculated the z-score, very simple. So we get the spread by subtracting C1 minus C2, and I'm selecting since index of 1 until the end, because the first value is going to be a NaN value, which is going to mess our calculation. So we need to skip that one. And then we use the z-score, which simply accepts the spread, and then I'm returning the last value of the z-score, because that's really the one that I care for. So you remember we were calculating z-score in the Jupyter notebook as well, and we were plotting it here, right? So here's the thing, the only value that we actually care for is the last one, because if that one, for example, is below this threshold, we want to go long. If it's here, we want to go short, right? So we only care about the last value, and that's why in here I'm also selecting only the last value. Now here's where actually the Jessie framework comes in. So we're using the before method, which is a built-in method of Jessie. What it does is that it will get executed before every single candle closes. What it does is that right after a candle closes when you're trading, this function is the first method that will get executed, which is a great place to put some extra calculations that you want to do so that later you're going to use to decide whether or not you want to open a position or close an existing one. Now I'm saying that if it's the first index, so if I have just started my session, we need to fill in these values, right? So S1 position and S2 position. So what these two variables are going to do for me is to decide at each point whether the position should be long, short, or closed. Now 0 is pointing to closed. And once every 24 hours, and this is how I'm calculating that, right? So I'm saying if the index is 0 or if the remaining of the division by this equals to 0, I want to check to ensure that the symbols that I'm trading are still cointegrated. Practically, I never use this, but if you're doing some research and you're not even sure if your symbols are cointegrated in the first place or not, I think it's best to include this part of the code, but otherwise, like, you can simply just delete these and nothing will really happen. But anyway, so we're using the rCointegrated utility function of Jessie, so we're not even calculating this by ourselves. And we're saying if they are not cointegrated, then simply put the positions to 0, which in other words, it means do not open any long or short trade. Next, we were getting the z-score, and we were saying that if the current position is closed and the z-score is below minus 1.2, which is this threshold that we had here, the first position must be long, the second one should be short, and it should also set the position sizing. Now here's the code for that. So we're using the calculate alpha beta utility function of Jessie. We don't really care about the alpha value, but we do need the beta, and we're saying that using the available margin multiplied by these, we are calculating the margin 1, which is how much margin we should be spending on the first position and how much we should be spending on the second position. So I did some research and came up with this formula, but I've seen people using different formulas, and I think this is also one of the parts that needs some extra research on our side, because the size of the position has a huge impact on the results that you're gonna get. And next, we're saying that if the current position is a long position, now by the way, when we're saying the current position, now we are pointing to ETH in the example that I gave you before. So we're saying that if it's a long position and the z-score is above 0, which in this case means that, you know, here we went long, but now this line is above the mean, which is this black line, or 0 in other words, then I want to close both positions. And when we set this to 0, not just this strategy, but every other strategy, which in this case is just another one, it will also pick up on this. So when it calls the update position function of Jessie, it will see, okay, this value has been set to 0, and now I need to liquidate the current position. And by the way, this function only gets executed when you do have an open position. That's why in here, we don't need to check to see if we have an open position or not. So you see, it's little things like this that makes Jessie framework really easy to work with. All right, so next we're saying that if it's a short position and the z-score is below 0, we also want to do the same thing. And if it's closed and the z-score is above 1.2, we want to go short with the current position, and we want to go long with the other strategy. And again, we want to set the margin values as well. And that's it really, like everything else is super easy. So next, inside the should long method, which is how we tell Jessie like whether we should open a long position at this moment or not, we're simply checking this value, which we set in here, right? So if it's 1, we want to go long. If it's -1, we want to go short. And if it is going long, well, here's where we do the actual position sizing. So we're getting the quantity using the size to quantity utility function of Jessie, but in it, we're not passing the current balance. We're passing this value, which we set inside the set proper margin per route function that we defined earlier. And then we're passing the current price and the fee price of the current exchange. And then we're submitting the actual buy order by saying self.buy equals quantity and then self.price. We're doing the opposite for short. And again, inside the update position method, we're saying that if the S1 position equals to 0, I want to liquidate the current position. So you see, it was super simple. If you remember the previous video, this was the result that we were getting before, and it looked fantastic. But the problem was that we weren't paying any trading fees, more than 7,800 trades. But the numbers were great, like the max drawdown was only -5%, which is absolutely amazing. Here's the benchmark comparing the equity curve of our strategy to the other trading assets that we were trading, which was ETH and ETC. But then after including the trading fees, this was the result that we were getting, which is absolutely horrible. And that was with this much trading fees, which is even a little bit higher than the trading fees that you're gonna pay on an exchange such as Binance. So we were including the trading fees and a little bit of slippage, and the result was this, which is horrible. But like I said in the intro of the video, in this one, I'm going to extend where I left the previous video, and I will show you a couple of tricks that I picked up, which really improved the results. Alright, so let's go to Jesse's dashboard and create a new strategy, and I'm gonna call this one First Trading 2025. Next, we can continue editing this from within the built-in editor of the dashboard, or we could copy this, go to another editor such as Cursor or VS Code, and look up the name of that strategy and find it here. Now I find this one more convenient, so this is the one that I'm gonna go with. So let's go and copy the code that we had before, paste it here. Firstly, let's update the name to include 2025 in it. And now I'm gonna keep building upon this. So let's copy the name of it, go to Jesse's dashboard, go to the backtesting page, look up the name of it. I want to trade this on the 15 minutes time frame, so let's change this to 15 minutes. And I'm gonna use BTC and SOL trading pairs. Now for the second strategy, I'm using this one, but it is basically the exact same thing that we had as before, except that I just made some updates to it to make things more dynamic. So for example, instead of here saying margin 2, I'm saying margin, and then I'm using this self.current route index, and I'm doing the same thing in here. And by doing this, I'm ensuring that if I, for example, were to trade not 2 symbols, but 4 or 6, I wouldn't have to change this strategy to update the number, right? So from 2 to 4 or 6. So I don't have to do that anymore. So that's why I did this. But you could use the previous code, or you could use this one. And I will share whatever that I'm writing today on GitHub and link to it in the description of the video. All right, so we picked this one, and here it is. For the duration, I'm choosing the first 6 months of 2025. And you need to ensure that fast mode is disabled, because when it is enabled, you cannot trade the strategies that use 2 different trading routes. So if I enable this and try to run it, it will give me this error. So I need to disable this, and I'm leaving the benchmark. You know what? Let's also disable this. Let's also check the trading fees, and let's set it to 0 first. Now let's run this, and here's the result that we're getting. So at this point, it lost a little bit of money, but from here to here, it was making money. And this is how many trades we made. And the max drawdown is minus 41%. So it's not great, even with 0 trading fees, right? But that's kind of expected, because in the previous video, I was using ETH and ETC, which are significantly correlated and co-integrate together. But here I'm using BTC and SOL, which aren't always going toe to toe, right? But because I want to show you the realistic values, the ones that I actually traded. So let's also bring back the trading fees. So on Binance, this is the actual trading fee that you're gonna have to pay for taker, or a market order in other words, which is what this strategy is using. But we're gonna set it to a little bit higher to consider the slippage value. Now let's run it one more time, but this time in a new tab, because I want to compare the 2 values. Now here's what we're getting now. So with the same number of trades, now we're losing 95% of the capital that we were trading. The max drawdown is minus 95%. So it's absolutely horrible and untradeable, right? Now this is before and this is after. So now let's extend where we left off in the previous video. All right, so the first thing that I'm gonna do is to define a new property, and I'm gonna call it a spread, and just return this, right? So I don't want to repeat myself doing this. Now the next thing that I did that worked really well was, instead of using the z-score and some simple hard-coded threshold, I started using Bollinger Bands. So that means we can simply remove this, and I'm gonna define this as BB, and in it we are using ta.Bollinger Bands, which is the correct syntax you just see for using the Bollinger Bands indicator. And instead of passing some candles, I'm passing the current spread values, which we define here. And as period, I'm using 20. And we don't even need to define these, so let's just remove it, and we're gonna go with the defaults. So that means now I can go to the before function again, and here I can remove z-score and replace it with Bollinger Bands. And instead of saying when z-score is below minus 1.2, we can say whenever the current spread is below the lower band of the Bollinger Bands. So we can say this, so the current spread, which we haven't defined yet, is below the lower band. So let's also define this. So let's go up here and simply define that. Actually, Cursor is smart enough to help us with this. So yeah, the current spread, but we're only interested in the last value of it. So we are returning the last value of this. All right, so let's go back. And here we can remove this and say whenever the current spread is above the middle band. And we also do the same thing here. So whenever the current spread is below the middle band, we want to close the position. And here we're saying whenever the current spread is above the upper band of the Bollinger Bands, we want to go short. So if we were looking at it in here, so imagine if this line here was the lower band and this one was the upper band of the Bollinger Bands, right? So we're saying whenever the current spread, which is this blue line, is above the upper band, you want to go short. Whenever it is below it, you want to go long. And whenever it passes the middle band, which is supposedly this black line here, you want to close the position. Now again, guys, this was the z-score, okay? It wasn't exactly the Bollinger Bands, but the way it works is very similar to Bollinger Bands, which I'm sure all you guys already know. And I got so much better results with this. So again, we defined the Bollinger Bands here, and we just use it in these places. So let's go back and rerun this one more time. But I'm not expecting to get like super good results yet because the main ingredient is still left. All right, so even as it is, we're getting better results, you see? So instead of losing, that much, we're losing less. And we are also taking less trades, by the way. So that's also another reason why we're losing less. But overall, I found this model to work better. All right, the next thing that I did that worked really well was using the ADX indicator. Now, in case you don't know what ADX is, so let's display it on TradingView. So here is this average directional index. All right, so what it does is that it tells us how much volatility there is in the market. So for example, at this point where we were in a free fall, you see the value was high. And in here, for example, where there wasn't really any kind of trend, the value of it was really low. So setting a simple threshold with the ADX indicator helps us a lot to find the moments that the market has a lot of volatility and there's a higher chance of insufficiency in the market. And that's what we want to do, right? We want to find the insufficient moments in the market and take trades and take advantage of those moments. So I simply set a threshold of 30. So on TradingView, that would be something like this. And I'm saying whenever the value of ADX is below the threshold, like in here, I'm not taking any trades. But if it's above it, like in here or here or here, then yes, I am looking to take trades. So let's define it here. I'm going to define new property and I will call it ADX. And simply in it, I will say return ta.adx, and then I'm passing, well, this is wrong. I want to pass the current trading candles, which I can get like this in Jesse. And we can also remove the period parameter. I will go with the default. Now, I want to say when the value of it is above 30, that's when I want to take the trade. So now let's go back here and I will also add this. But we don't need it for closing the trade. So not here, but also in here, I will add this. The next thing that I did was simply defining a trend filter. So let's go ahead and do it. So new property, I'm going to call it trend. And in it, I'm going to use the comma indicator. Feel free to use whichever you like. You can use moving averages or whatever. But I found comma to be very simple and work best for my use case. So I'm going to say k equals ta.comma, and then I'm passing the current trading candles. And here I'm saying if the current price is above the k value, it's an uptrend, otherwise it's a downtrend. And then in my trading rules, I'm saying that for this one, I want it to be in an uptrend because I want to go long the first position. And in here, I will do the opposite. I will say that if it's a downtrend, in other words, if the trend equals -1, I want to go short the first position and long the second position. So let's go back and run this too. You see, it's again improving our results a little bit, but we're still executing 286 trades and the drawdown isn't great either. All right, so let's go back and define another filter. Now, this one is the most important filter that I defined. The main problem with the previous results that we were getting was that we were executing too many trades. So even the trades that weren't really worth it, just because the value of the z-score was below threshold, we were taking a trade, right? We weren't checking to see if PNL wise the trade was actually worth it. So that's what we're gonna do now. So let's define it, and I'm gonna call it is worth opening. And in it, I will say return the abstract value of the current spread and its last value to be above a certain number, and I'm going to use 1.5 Now, depending on whichever coin you're trading, you're gonna need to change this. So for example, if you're trading meme coins, the volatility is going to be higher, so maybe you want to catch bigger movements, right? So 1.5% may not be big enough. So for a meme coin, maybe a number such as 4% would be good. But for more liquid coins such as BTC or SOL, I'm going with 1.5. And the problem with choosing something below that is that the trading fees of the exchange is going to kill our results, and that's just not good enough for me. Alright, so let's go here and add this as another enter rule, and also do the same thing in here. Again, we don't need it in here. Now let's go back and remember this number, right? So actually let's open a new tab, because again, I want to compare the results of all of them. And there we go. So it drastically improved, right? So now we're executing only 28 trades, the ones that are actually worth it. And the win rate is 28%. That's not awesome. The max drawdown is minus 10%. And if we go to the benchmarking page, we can compare the results here as well. So you see they're all negative still, but we went from minus 12 Sharpe ratio to minus 5 to minus 2. Now this one was without trading fees, so we don't really need to keep this open at all. Let's close it. Now here's the thing, just like we are saying, is the current trend worth for opening in the first place? We can also say, like, is it worth to close it? Because why should we always wait until the value goes above the middle band? What if we're not making enough PNL yet? So just like that, we can also define another one. With this one, we're gonna call it is worth closing. Now for this, we're gonna have to get the current PNL of the current position. And here's how we get that. So P1 equals the current route, the first one, and then we're selecting the strategy just so we can access its position, and then its PNL. And we're doing the same thing for the second position. So by the way, this is how you can access the value of the other trading routes that you have from within one single strategy in Jesse, right? So you will use the current routes array, and then you have access to all of them. So you pick the strategy, and then its position, and then its PNL. So then we're saying the total PNL equals the P1 added by P2. So remember, one of these is probably going to be negative, but when we add them together, that is going to give us like the remaining value. And then we're saying the total PNL divided by the current position's value multiplied by 100. So we can have it in percentage, should be above a certain value. And because we chose 1.5% here, we might as well do the same thing in here. So I'm going to change this to 1.5. So we're saying that we only want to close the current position if we are in a profit for more than 1.5%. But I don't want to always do this, because what if we are losing money, right? So what if the price is going very much against us and we're losing more and more? We don't want to keep holding the position, right? So for that reason, I will also define another one, and I'm going to call it time to a stop. So this is how we define the stop loss here, because in a typical strategy, we submit the stop loss as soon as we open the position. But because this is a pair trading strategy, we don't look at just the PNL of the current position. We need to add them together like what we did here, right? So at any point in time, we need both values. So that's why it's going to be a little bit tricky, and we cannot use this typical stop loss order. So instead, we need to check at each point to see if the current losses is bigger than a certain percentage. We're going to close the current position. We're going to liquidate it, right? So to do that, we will define it like this, very similar to what we just did. And we're saying if the current total PNL is below a certain number, and I'm choosing minus 5% here. Again, feel free to choose whatever number that works best for your use case. If that's the case, I want to close the position. So either close the position when it is time to stop, because we are in so much loss, or when we are in a good number of profit. Again, you need to play around with this value, and for this pair, I found this number to be good enough. So let's go back to our before function. Now this one is for closing, so we no longer update this part. So instead, I will do this. So I'm saying and either when it is worth closing or when it is time to stop. So remember, if you put and instead of or here, it's going to ruin everything, right? So we did it like this, and again, we need to do it one more time. And if I go back and run this one more time, hopefully it should improve our results. And there we go. So you see, now instead of losing money, we are earning a really good number. So 18% in 6 months, max drawdown of only minus 2%. The win rate is 87%. So these are really good. The Sharpe ratio is 2.81. And again, guys, remember, this is while we are indeed paying for trading fees. So you see, we started from this. So this is what we had in the previous video. And in this one, we have this. So these aren't even comparable, right? And by the way, I did cherry pick the period of the backtest. So let's go and go a little bit further. So let's choose 2024. And here, let's move this up to November, which we are in right now, and let's see what will be the results then. All right, so in 2025, it actually continued to perform really well, but in 2024, it wasn't so great, especially in this period. All right, so here's the thing. I ran the strategy in 2025 myself, and it did perform well. And as you can see in the backtest, here's the reason, because even in the backtest, it was doing well, but at the end of 2024, it wasn't doing well. So I was a little bit lucky. But here's the thing, I made the changes that I did based on what made sense to me. I didn't even run optimization mode on it. I don't think we even support multi-trading routes in our optimization mode just yet. So I didn't do that. I just made the changes based on what made sense to me as I explained everything to you. But still, I wouldn't say it's a perfect strategy. As you can see, there are some periods that it could lose money. And besides that, when I ran it live, I faced one very important issue, and that was the slippage. So in the trading fees, we set it here to this number. So a little bit higher than what the trading fees are for market orders on an exchange such as Binance. But in reality, the slippage was a bit higher. Now, I did not trade on Binance. So if you are, you have access to more liquidity than what I did. So I wasn't trading on Binance, and the exchange that I was trading in, this was the default trading fees. So including a slippage, the actual fees that I was paying was something like this. So that's another thing that you need to remember, especially if you're going to trade this strategy on something like a meme coin. I would say you're going to get way more opportunities and better ones because the volatility is higher in meme coins, and so are the insufficiencies. But that also means when the volatility is really high, and remember, exactly in those points, that's where the market makers will stop providing liquidity, and that will make your slippage number even higher. So you need to consider that. So increase your trading fees to a number such as this or even this to be prepared for that. And the other thing is that instead of just trading 2 pairs like I did here, why not trade, let's say, 4, 6, 8, or 10 pairs at the same time, right? Because then you're gonna get significantly smoother equity curve, which is really awesome. So all the values such as your max drawdown or Calmar or Sharpe ratio are going to better if you trade more trading pairs using something like this. And as you guys already know, we do have a strategy index page where I submit all the strategies that I show you guys with the backtest results for other symbols and timeframes, and you can check them out here. But I'm not going to submit this one because this strategy uses 2 different trading pairs and our strategies page doesn't support that yet. But a huge update is coming to this page, and we're going to have way more strategies and better metrics and everything on this page very soon. So if you haven't checked out this page for more strategies, make sure to do so. As many of you guys already know, I am obsessed with statistical arbitrage, so this isn't really the end. This was just the updates that I had for 2025. So I will definitely continue working on this strategy and hopefully improving the results of it. And before I leave you, we're gonna have a giveaway. A random subscriber who likes the video and comments their opinion is going to win 1 million Bonk token. Alright, let's pick the winner for the previous video. And the winner is, I'm not gonna read their name, but I do appreciate your comment. Now please reach out to me so I can send you your Bonk tokens. Thank you so much for watching. I'll see you in the next video.